A successful retirement is about getting the big things right. But every year, I see near retirees in their 50s fail with retirement planning because they spend too much time on the small items. They want to talk about tax loss harvesting and where to put their cash and when to take Social Security. It's not to say that these things don't matter, of course they do, but what we're talking about today has a 6-figure, sometimes 7-figure impact for most retirees. And that is exactly where the focus should be. By the way, I'm Rachel Camp, and I am a CFP professional and the founder of Camp Wealth, and we help people confidently retire before age 65. So let's get into it. So today's video is based on a couple who came to me in their 50s, and they were really worried about their retirement plan. So we're going to call them Mark and Linda Sample. You see, Mark and Linda faced a problem I see pre-retirees face all the time. They want to retire early, but all of their money is in pre-tax accounts. And the problem isn't because they can't access these accounts until age 59 and a half. They actually have enough in their brokerage account to bridge them to that age. But the problem is that they are worried about the looming tax bomb. They felt pretty good about contributing all money into pre-tax accounts until somebody came up to them and told them, hey, you're not avoiding tax, right? You're just deferring your tax bill to a future date. So they came to me quite panicked because Mark and Linda had felt really good about the $2 million in their IRAs, but now all of a sudden they saw these accounts as a major problem. They wondered if they had made the wrong decision this entire time by kicking the proverbial tax can down the road instead of paying the tax up front and just getting it out of the way. And the other thing that started to really concern them was that they thought that their $2 million IRAs weren't really worth $2 million. They had built a retirement goal of somewhere around $2 million and knew that would be enough to sustain their lifestyle. But because part of this account technically belongs to the IRS, what is it actually worth? Is it worth 1.8, 1.5, 1.2 million? And if that's the case, can they actually retire? Here's the thing. I'm going to get part of the ending away right away because I need Mark and Linda to feel better right now. Mark and Linda had not done anything wrong yet. Contributing to pre-tax accounts while working and in a high tax bracket is not a problem, but if they do nothing to address this, it could cost them 6 figures in taxes. Here's what I mean. So here's Mark and Linda. We have Mark who is 57 and Linda is 53, and they want to retire next year. They have $10K in their bank accounts, $350K in the brokerage, and $2 million in traditional IRAs. That's all pre-tax money. Now, if we jump over to their plan and run a Monte Carlo simulation, everything looks great. Even when I add in the cost of pre-Medicare health insurance for them, they're still in that green 91% chance of success. Because their spending relative to their assets is pretty reasonable, they're doing great from a cash flow perspective. So what's the problem here? The current problem is their lifetime tax bill and just how much they will pay in tax if they do nothing. Remember, this is money they could spend. They could use to upgrade their flight, to spend more time on vacation, to give more to their children, and it's currently going to the IRS instead. So what we're looking at here is a graph showing their tax brackets throughout retirement. And what you'll see is things look great for a while. 2025 is their final working year, so they are in the 22% bracket. The pink line at the bottom is the 10% bracket, which you'll notice is their marginal tax bracket in the first few years of retirement. And they're not even filling that up because they have no taxable income in the first few years. This is due to them pulling from their brokerage account and living off cash and brokerage account assets in the first few years. So if you look at this, you'll think, oh, there's no problems here. No tax bill sounds great. But when we zoom out and we go to future years, that's when things start to change. You see this huge jump in tax brackets in the year 2047. This is the first year that Mark and Linda are both RMD age, which is currently age 75. RMDs, or required minimum distributions, is the IRA's way of knocking on the door and saying, hey, it's time to pay up. You have deferred as long as you can for this money, and we want a piece now. Problem is, these IRA balances are now huge because they have been left to grow for decades. So when you go to calculate your RMD, it's massive, meaning it's more than they even need for spending in those years. So if we switch over to cash flow, you will see the RMD combined with Social Security, because remember, they're age 75 here now, so Social Security is definitely turned on. And this amount, the cash flow coming in, is way more than they are actually spending. Starting at Mark's RMD age of 75, they have positive cash flow of just under $25,000. Again, it's $25,000 that's not getting spent. It's just sitting in cash or maybe getting reinvested in a brokerage account. So the RMDs are forcing out this extra money and they're getting taxed on it, but they're not spending it. We go forward to 2047 when they both hit RMD age and the problem gets worse. There's now $70,000 being forced out that they are not even spending. The further we go out, the bigger the problem this becomes. By the year 2053, they have six figures in unspent money because the RMDs are over $200,000. In the cash flow overview, you see this orange line is their actual expenses and the orange bars are the RMDs. So what we see here is a ton more than expenses or spending money is coming out. It's being forced out. And what's happening is that is what's forcing them into a higher tax bracket, again, on money that they are not even spending. It's leaving these tax-deferred accounts. It's going into cash or it's going into a brokerage account and now it's getting taxed. Okay, so what can we do about this problem? Is there anything we can do? Of course there is. I'm not ending the video here. We're going to get into a solution now. And the solution lies in the first 10 to 18 years of retirement before they hit RMD age. As early retirees, we've got additional problems with pre-Medicare health insurance and accessing retirement accounts before age 59 and a half. But one huge advantage you have as an early retiree is you have a ton of time until RMD age, and we can use that time to fix this RMD problem. So remember those initial years where we might have been excited about that $0 taxable income for Mark and Linda? Well, we shouldn't be, because this is tax inefficient. What Mark and Linda are doing here is leaving money on the table. They have more income in these years they can realize at a 0% tax rate. So this is a simple question. Do we want to pay tax during these years at 0% or even 10 and 12%? Or do we want to pay them later at a projected 22% marginal tax bracket? That is a 10 to 22% tax difference. That's massive. So let's do something about it. Of course, we're going to talk about Roth conversions here. We don't want that money sitting in these pre-tax accounts just waiting for a massive tax hit. And then we don't want them forced out in future years and then sitting at brokerage accounts where they're going to get taxed. Let's get those dollars over to a Roth bucket, a Roth account where they can grow tax-free. Now we're going to discuss something with Roth conversions I see rarely discussed. There is this hyper-focus exclusively on marginal tax brackets. And to be fair, that's just what I went through with the analysis of 0% versus 22% in the future. But it doesn't tell the full story. As a reminder here, a marginal tax bracket is the tax bracket on which you pay your last dollar of income. We're going to run through a quick education here of U.S. tax brackets. In the U.S., we have progressive tax brackets. What this means is we fill up tax brackets $1 at a time. So if you have $100K in taxable income, you're married filing jointly in 2025, this is how you pay tax at the federal level. You pay the first $23,850 of taxable income at 10%, the next $73,100 at 12%, and finally, the remaining just $3,050 gets taxed at the 22% rate. So you don't pay the entire amount at 22%, you're just paying your final dollars there. So when we discuss Roth conversions, we focus quite a bit on that marginal tax bracket. For Mark and Linda, their marginal tax bracket is 10% in early years of retirement and 22% when RMD start. So it's correct to say when we do Roth conversions, we are choosing to pay tax on them at 10 or 12%, so we avoid tax later at 22%, assuming that tax brackets stay the same. So while that is correct, it's also not the entire story. I'm going to introduce something called a marginal tax rate. While your federal marginal tax bracket is the tax you pay on your last dollars of income, your marginal tax rate is all of the additional costs you pay by realizing additional income today. So I'll explain what I mean here with Mark and Linda. So we want to fill up this 10% bracket. We even want to fill up the 12% bracket, right? Because 12% definitely beats 22% by quite a bit. But Mark and Linda are paying for health insurance on the marketplace. So it's not just the additional tax bracket they have to worry about, but now they have to worry about the cost of health insurance rising if their modified adjusted gross income is too high and they're phased out or partially phased out of some of these subsidies. With marketplace insurance, you qualify for subsidies where MAGI, that's modified adjusted gross income, falls between 100% and 400% of the federal poverty level. Now, your eligibility for subsidies depends on your family size, age, where you live, and of course, income. So it's worth going to healthcare.gov and shopping the cost of your health insurance to see how adjusting your income impacts your subsidies. These subsidies are called premium tax credits. So they aren't deductions, which just reduces your taxable income. They are actually a dollar for dollar reduction in your tax bill. What this means is when we are considering reducing our taxable income versus a tax credit, the tax credit wins as a better deal. So you must consider this extra cost when analyzing your marginal tax rate. What I would do here is start with comparing your current tax bracket versus projected future tax brackets. That's what we did for Mark and Linda when we said, let's fill up 12% because we're projected to be at 22% in the future. And then once you fill up that 22% bracket, look at your modified adjusted gross income and see if there's anything that with bumping your MAGI up to that level, if it phases you out of credits or deductions that you would qualify for otherwise. So we're going to do that here with looking at the first few years of retirement for Mark and Linda. So we assume about $20,000 in interest that's coming off this portfolio that's just under 6% interest on a $350,000 brokerage. We could arguably make that more efficient, but for simplicity, we're going to keep it there. So no capital gains this year because they have cash and this interest to live off of. The tax report here is very simple. You'll see adjusted gross income with that is just that interest amount at $20,328. That is going to be the same as their modified adjusted gross income because they have none of those adjustments that are added back. So using this, you can shop out your health insurance and see where this lands you for premium tax credits and start to see if you need to realize additional income to get to 100% of federal poverty level to avoid dropping into Medicaid. With Mark and Linda, only having that income of $20,000 actually does drop them into Medicaid. So they actually need to realize additional income to avoid that. We play around with healthinsurance.gov. We look at different plans here, features, and settle on an adjusted gross income of $45,000 for them. This way, they will still qualify for a large premium tax credit and not drop down into Medicaid. So we add $25,000 in a Roth conversion to see how this impacts their tax, and that gets them to $45,000 in adjusted gross income. With this number, they are also fully taking advantage of the standard deduction at $35,300. This is another thing you don't want to go unrealized. The IRS is giving them $35,000-ish in income before they even start to get taxed on these tax brackets. So previously at $20,000 in income, they were leaving about $15,000 of income that could be taxed at 0% just on the table. So after the standard deduction, we get a taxable income of about $10,000. So we're still in that 10% marginal tax bracket. Now, this does become a complex decision of maximizing for ACA subsidies versus Roth conversions and future RMDs. I take this decision year by year as subsidies change, tax brackets change, and tax law changes. But if we look at the software here for lifetime tax bill, we see just by entering a Roth conversion where we fill up the 12% bracket, we bring the lifetime tax bill to $579,000 from $950,000. You also have the fun wrinkle here of being careful not to over-convert like we did here, and now we don't have any income to fill up that 0% bracket later in retirement, assuming they do live that long. So Mark and Linda should take a close look at this every year, starting with their base income, which is just interest and capital gains from the portfolio, seeing where that puts them for health insurance subsidies. Eventually, Social Security will be added to their income as well. This will shrink the room left in their tax bracket, which is why early retirement pre-Social Security is such an important time for Roth conversions. Like we discussed with marginal tax rate, they also need to be sure to consider all additional costs for adding income. When they turn 63, they now have to watch out for Medicare surcharge. This is the additional income you may have to pay for Medicare if your modified adjusted gross income exceeds a certain point. 2025, it was $212,000 for a married couple. Medicare surcharge is not one you want to pay because it is a cliff-like expense. Unlike our progressive tax rate system where only your last dollar is taxed at the higher rate, Medicare surcharge adds the full additional expense if you are even $1 over. We can see as the tax code changes, this decision becomes even more complex. Those who are 65 and older now receive an additional deduction up to $12,000 for a married couple and $6,000 for single, but are phased out starting at $150,000 for a married couple. So now a couple whose original strategy was converting up to 22%, they now have to consider the additional costs and giving up that deduction and plan around it. You can start to see how many different variables go into this, and why it's not completely accurate just to compare marginal tax brackets. For Mark and Linda, there are 4 main phases they need to focus on right now. First up, converting up to 10 to 12% bracket while paying attention to subsidies for their health insurance and weighing the trade-offs every year. Next, once they hit age 63, they are 2 years for Medicare. And remember, Medicare is a 2-year look-back provision. So now they need to make sure their income stays under Medicare surcharge amounts. And then at age 65, they need to pay attention to enhanced senior deductions and be careful they aren't phased out of that additional $6,000 deduction, if that's still around, because they are 8 and 12 years from age 65. And like I just cannot say enough, the tax code is constantly changing. Then they will turn on Social Security and analyze the impact of taxation for Social Security. On top of all of this, we have conveniently been ignoring state tax. And Mark and Linda currently live in California, but plan to retire in Florida. Can make a lot of sense to defer some income until they get to that 0% income tax state. This is not the simplest of equations, but I hope this case study opened your eyes to understanding all of the variables that go into the question of convert versus don't convert. It would be much simpler if I just showed you the difference in marginal tax brackets, but it would not be the full story. Now, if you want help creating your own retirement tax strategy, click the link in the description to book a call and see if we'd be a good fit in working together. I'll see you in the next one.